start the recording. 1 second, Simon.
Sure.
Here we go. Yeah, all good to go.
Good stuff. So thanks everyone for joining. If you've been in one of these workshops before, then you'll know me a bit about me, but I'll just introduce myself quickly for everyone else. So I'm Simon. I run two legal businesses. So one's called Accelerate Law, which is a legal services business for startups and entrepreneurs, and then Legal Sidekick, which you can access at legalsidekick.com, is our platform for entrepreneurs and startups to create their own legal documents, access legal information, and kind of generally work their way through the legal part of starting a business. So a lot of what I'll talk about here is I'll talk about the theory of and the practice of how you go about understanding a funding round and also implementing it. And I'm going to mostly talk about it in the context of you can use these products to do so in what is hopefully a straightforward way. So my email address is there. It'll be at the end as well. If you ever want to contact me, feel free. So this is all about term sheets and closing your funding round. So hold on, how do I get to the next one? So I suppose the first thing is for all you guys, you're interested in, I think understandably so, if you've got money lined up in some way, what you want to know is that you can close it as quickly and efficiently as possible using reliable legal documents. So before you kind of have develop a deeper understanding of how it all works, I suppose you'll be able to do it using Legal Sidekick. And then what we're trying to do here is to make sure that you actually understand the documents that you create and the deals that you enter into with investors, so you understand the implications. But what you can do, I suppose, in summary of the process, and we'll go through it, is you can, through Legal Sidekick, you can create your term sheets and your full investment documents and close them with investors. So when a term sheet would look, if you were going through the process simply, you'd search for the document term sheet, create an account, and this is what it would, this is kind of a screenshot of the top of one of the documents, what it might look like. Let's do this tonight in the context of an example. So let's say your business is raising money from a group of rich angel investors, collectively looking to invest £200,000 in exchange for 20% of your business. So you've lined that up, and then what do you do? So the first thing is maybe a pre-step. So, and ideally you can do this before you have formal investment lined up, but and this should apply to most businesses and most of you in here. You should be applying for an SCIS and EIS advanced assurance. So this is a tax relief from the government. So it entitles your company, so it stands for Seed Enterprise Investment Scheme and Enterprise Investment Scheme. And what it does, it entitles your company for SCIS to receive investment of up to £150,000. And that investment, the investor is entitled to obtain amazing tax reliefs on it. So it's something that you apply for in advance of receiving the investment, and you can demonstrate to the investors in advance, we've got this, so any investment you make will qualify. And so what you can see here in blue is effectively the benefit that you can communicate. So just using an example of, if someone was investing £100,000, you can say to your investor, if you have this SCIS advanced assurance lined up, you can say, so if you're investing £100,000, you can effectively claim 50% of that off your next income tax bill. So very practically, it's basically like saying they're actually investing £50,000 rather than £100,000. It's like a 50% discount. So it's an amazing benefit for the investor, which enables you to sweeten the deal of your proposal to them. For EIS, just switch that 50% for a 30%. So it's still a very good thing, but initially the first £150,000 is open. But bear in mind, it has to be a UK taxpayer because it has to apply to their UK income tax. And then the second half of it is basically if everything goes wrong, so rather than losing £100,000, the long and short of it is on a £100,000 investment, the maximum loss is £27,500 because the £50,000 has come off the income tax bill, and then it's the remainder. They get 45% income tax relief on the remaining £50,000 loss. So it's extremely enticing. It's something that I would recommend to any startup that's seeking to raise investment applying for in advance. Our service, you see that on Legal Sidekick, we charge £200 for that. It's just a fixed fee if anyone needs our support on that. But in any case, I recommend looking into it and getting those applications off if you are seeking to raise money. Okay, so there's a big chart that's about to come up, so kind of try and just kind of read it step by step. This is the step by step of how to close a funding round from a legal perspective. I tried to kind of put these things in as individual rows coming up, but this will kind of give you the picture of what it looks like. So what I'm going to do is I'll just go through a summary of how it works. So first thing that you'll usually do is once you've got the kind of the headline terms, the Dragon's Den style stuff like £200,000 for 20%, what your investors are then expecting is for you to send them, they'll say, okay, what now? So what they're then expecting is for you to send them a term sheet. So a term sheet is a summary of the terms of the investment, and we're going to go through what are contained in those after. You can create that document on Legal Sidekick, and then you can customize it, make sure it fits what you're looking for on the platform, download it, and then send it to them. They don't necessarily need to sign it, they just kind of need to see it and broadly agree to the terms that you're putting forwards. Once that's agreed, then you move on to part 2, which is the kind of the big main document, which is covering this investment. So that's your investment and shareholder agreement. Again, that's another document that you can create on Legal Sidekick. The question, I'll kind of do a demonstration after you basically answer some questions, which customizes the preset template, and then you download it. And then also, often you don't need to update your articles of association, which is like your company constitution. That's point 3 because it's covered within your investment. The relevant points are covered in your investment and shareholders agreement. But if you do want an additional one, then we can also put that together for you. So basically, the core legal documents is what it's all about. So it's one and 2 basically. Everything else that you see is just kind of administration stuff that you might kind of get support on, or you just kind of go through it and you take a couple of hours and go through these things. These are not complex, difficult things. The key thing is points 1 and 2 here: term sheet, investment and shareholders agreement. And the point is, when people talk about funding rounds and the legals, really what they're talking about is you're sending this big document to your investors. They might have questions, and it's just about negotiating those key points. And this workshop, hopefully, I'm going to be able to help you understand what those key points are a bit better. So when you send point 2, this investment and shareholders agreement across, hopefully they sign it. You send them an email with the document. They'll sign it. You say, please sign it and please send the money, and that's basically that. And then you'll have the money in your account. And then after that, it's your responsibility with supporter advisors to prepare the secondary documents to make sure that kind of everything is in order. So you're issuing the shares at Companies House, you're giving them share certificates. So it's something that once you kind of understand what it looks like, it's not overly complex. It's just a case of getting the key points right, which we'll go through. It's all doable through Legal Sidekick, but like before Legal Sidekick, it's the kind of thing that we still do. We do it manually. That ends up it's a different kind of process, but it's still kind of something that which the majority of companies do, and it works well, and you get kind of a lot of personal support. So we're going to look at now, like, obviously you can go through these steps. You can create the documents, they'll be there, you could send them off. If people weren't going to question them, they might just sign them and say, here's the money, which is potentially very good. But equally, it's important, and I think part of the reason you're in this workshop as well is to understand what's going to be in there and how it impacts your business. So what's in the seed investment term sheet? And this is also kind of, the term sheet is a summary of what's in the main agreement, the main investment and shareholders agreement. So this is basically, what is in the agreement, what is covered in an investment and shareholders agreement. So first thing is, so you're looking at basic company details. So, your company, who the investors are, what they're giving you, the amount of money, the amount of equity they're getting back, those top level details. And that's what you've more or less agreed up front. So after that, you're looking at, so what are the investor benefits? So other than the fact that they own shares in your company, which is hopefully going to kind of return a big profit to them in future. So what are the other benefits to them? So SEIS, EIS availability, that's a big one, and that's often going to be conditional. Their investment, if it's a UK investor, will maybe conditional on having that tax relief lined up. And then, so in exchange for their investment, what they're essentially doing is they're buying shares in your business. So when we talk about, you get 20%, if we just think about that in detail, that means they're being issued a specific number of shares in your business, which equates to 20%. So those shares, what do those shares mean? So it means if the company is sold, if the company is sold, generally that means that the shares are being sold. So they'll have, if they own 20% of the shares, then they'll get 20% of the profits of the sale. But what it also means is, kind of more operationally, they'll have a right to vote. So each shares carry voting rights proportionately to the percentage that they hold. So if you hold 20%, you hold 20% of the votes in the company. If you're an investor, you're thinking, well, okay, I only hold 20%. I'm always going to lose the vote, which is why there'll be a few other protections that we'll look at shortly to protect against the minority basically always losing. Then information rights. So if you're an investor, you want to make sure that you keep in touch with the company that you've actually invested in. So you might want to see an annual business plan and accounts. And some investors will also want to be a director of the company. They might want a board seat. One compromise there is if someone wants to have that, but you don't want to give them that level of insight, really, you might offer them a board observer role. So it means they can attend your board meetings, which might happen, once every 3 months, but they won't have a vote at the board meeting itself. So the meeting of the directors, it might be you and your 1 or 2 co-founders. The investor might be there, but they won't actually have a right to vote on matters as a director. So the next thing is operational plans. So founder roles, they might want to know what you're doing, and they might also want to commit you to a vesting schedule to make sure that you actually remain with the company. So, i.e., that you earn your shares over time. So if you leave in 2 years, you don't get to kind of just walk away with 50-80% of plus of the company, because that would be there's too high risk. If you're an investor, you're basically thinking, so I'm going to put all this money in, but then the founder, who's basically the kind of the key person in the business, could just leave and my money's basically lost. So that's protecting them against that. Management, who are the directors? Generally, that's going to be the founder. So if you've got a few co-founders, generally all of them will be directors. And then the question is whether will the investor also be a director? How and how often does the board meet? So generally, once a month, once a quarter. Share option scheme. So generally, this is an important point. So in future, you might want to put in place a share option scheme for your staff, so you can issue options to them to incentivize them as part of their role, and then they get to share in the profits of the company in future, all being well. But generally, you want to say that you're entitled to issue those options in future, and there's no kind of barrier to doing that, and there's nothing that the investors can do to prevent it. And then we're looking at the kind of more detailed investor protection. So again, if you're thinking about it from the investor's perspective, what they want to know is, okay, they're investing the money because they believe in you and the business, but they also need to make sure that they're not going to be treated unfairly, that the business isn't going to be run in a way which they kind of would really not approve of. Now, the investor protections part is the key part that really is going to be negotiated, because this is generally talking about the level of control which the investor has over your business. And generally it depends, but your position is probably going to be that you want to limit the control that the investors have over your business, whereas the investors may not, but they may want to kind of exercise extra levels of control. So just going through each one of these points. So anti-dilution. I think a lot of people are familiar with dilution from watching The Social Network, the Facebook film, where there was a big thing where one of the co-founders was ultimately diluted so that his share basically equaled nothing. So investors have it's basically enshrined in the law. So it's a legal provision that would apply even without it in this agreement, that you have something called preemption rights. So it means that you can't simply just issue 1 million shares to yourself. If you're issuing 1 million shares to yourself, they have to be, if you're issuing 1 million shares, they have to be offered to all of the existing shareholders proportionately to what they hold. And so if someone holds 20%, and you're issuing 1 million shares, then they would need to be offered 200,000 shares at the going rate, which is basically saying that they'll retain their 20%. So what anti-dilution means that, so it doesn't mean that investors can prevent you raising money in future, but what it means is they're entitled to participate in investment rounds in future to prevent them being diluted. Then you have rights which prevent kind of shares being transferred without certain consents. So especially that may apply, the investor doesn't want the founder, for example, to just transfer half of their shares to someone because the founder's then less incentivized, and it means that there is a reduced chance of success. Preference, sometimes investors, more likely to be kind of a VC, big institutional investor, might insist on having a preference, which means if the company goes, basically means if the company is going out of business, they get their money out first. You want to avoid that, especially if you're receiving just normal angel investment. You should generally just be having ordinary shares. Everyone has the same type of shares. You don't need to be getting kind of issuing lots of different classes of share. It should just be everyone has ordinary shares, and the other provisions are kind of sorted by all the other points on this page. So consent rights are important because basically, if you're this is the idea that the investor can control certain operational matters. So what you'll have, when we say consent rights, you'll have a list of matters or a list of items in the document which will say you need to have the investor's consent to do these things, or you need to have a majority of the investors' consent to do these things. For example, buying a new company, or borrowing money in excess of a certain amount, or spending in excess of a certain amount, or winding down the company and basically ending it. So the very, very important thing with the consent rights is to just limit them, really. You want to make sure, I reviewed a term sheet today where the investor was looking to have a consent right over issuing new shares in future. And what that would have meant is that the investor has a right to say no to future investment rounds of the company, which is not good. You don't want to be at the disposal of investors like that. You want to maintain control of that relationship if possible. So you want to ensure that, yes, there are some consent rights, but they're limited to more existential matters. So, for example, winding down the company, completely changing the nature of what the company does, things like that, which are not going to impact day-to-day operations. So that was a lot. The term sheet well, effectively, that can all be crammed into, let's say, 2 or 3 pages. But then all of that is going to be fleshed out in the full investment and shareholders agreement. But I think, okay, obviously that's a lot of information to take in. But if you're just kind of clear on the 4 categories, so basic details, investor benefits, what are they getting, operational plans, like what does the company look like on a day-to-day basis operationally, and then investor protections, like how is the investor being protected from being, from the risk which any investor might be subject to in investing in an early stage business. So I think you don't need to know absolutely every one of these things in great detail, but it's important to have a good overview. If you're sending the documents to people, if you're entering into this kind of relationship with investors, what does it entail? In some cases, it might put people off getting investment. You might say, okay, I'd rather raise money in some other way, or just kind of grow organically, because obviously once the investors have put money in, it means there's more pressure on things. But I think in many ways you need that to kind of push things forward. If there are any questions at any point as well, please do type in the chat or let me know. So this is all about the term sheet. So as I said, it does translate into the main document. So let's just look at a bit of, if we just take through our example, so where you've got your angel investors, they're putting in their 200,000, they're getting 20%. You've got your SEIS and your AIS lined up, so you can give them the big thumbs up on that one. You're going to send them you're going to create your term sheet, send it to them. All being well, they'll agree to what's in there. And then you say, okay, well, we'll now follow up with the investment and shareholder agreement for you to sign and send us the money. They might have questions on it, so they might be asking you about if I look at these points and say, what are the points that your angel investor is going to ask about, they might say, okay, they might ask in particular about the consent rights, because they want to know, right, well, we want to make sure that we kind of have a level of control over how this is working. They might want to ensure, and they might want to know about the founder roles, like the vesting provisions are definitely kind of relevant, because at this stage a lot of it is an investment in you. So let's say you've sent your angel investors the full investment agreement, and I suppose what might happen then is they might have some questions for you. So you might engage myself or a legal advisor to help you with these questions. But at the same time, it's important. I think it's good for you to understand them. So SEIS and EIS, as we said above, these are the tax reliefs that they would ideally like to have available to them for UK investors. For SEIS and EIS, once they've made the investment, you do a filing online, but then you're basically just giving them a certificate. They then take that certificate, so when they're doing their own taxes, it applies there. You don't have to do anything else in terms of your actual company operations other than give them that certificate and say, here you go, apply this to your taxes. So dividends, this is when we talk about dividends. So if you're running lots of sole traders, for example, you might have heard that they'll take a small salary and then they take through PAYE, and then they'll take a dividends for the rest of the money that they take, and that's kind of a tax efficient way of running a kind of sole trader type business. Here, though, dividends is what dividends is specifically is a distribution of profits. So it may be one for an accountant more, but generally, if your company doesn't have profits yet, and investment from an investor is not profit as such, that's just basically called share capital. So dividends is a distribution of profits once you're making profits, and generally that will be, you can only distribute that generally proportionately to what everyone holds. So if you hold 20%, and then there was a distribution of profits, you'd be entitled to 20% of everything that's being distributed. I'm just looking at a couple of questions here, just to take a breather. So Dominic said, would you do a term sheet for pre-seed round? Also, is SEIS available pre-seed? So I would say, honestly, I think people talk about seed and pre-seed in different ways. It's not like, I think it's a bit kind of basically marketing terminology. So I think it's more in terms of, some people would say a pre-seed round is like £1 million. Someone else might say a pre-seed round is £10,000. So it's hard to know what that is. But basically, I would say it's more about the actual people who are investing. So if you're giving investment to your uncle and he's just going to sign whatever you want him to sign, then you may not need a term sheet as such. But equally, if people are going to kind of want to kind of pay even the slightest bit of attention to what's in the document, it's worth having a term sheet, because basically the full investment and shareholders agreement is 30 plus pages. Term sheet is 2, and it's a summary of what's in there. So it's much more simple to negotiate a 2 or 3 page term sheet and get those headlines agreed up front than start to get into kind of negotiating a very long document, which could really slow down the process. So the term sheet is generally a good way to actually speed up the process. You don't need to have it signed. You just want to have that kind of lined up and agreed up front. So, and is SEIS available pre-seed? So SEIS is available on the first £150,000 invested in your business, provided that you're registered for it. Provided that you're eligible for it, and if you've had your advance assurance, you can confirm to investors conclusively that that their investment will be eligible, and I think that's an important thing to have done in advance. So yes, SEIS is available for the first £150,000 invested. So Amar has said, hi Simon, your suggestion on advanced subscription agreement, say for fundraising, when to use it, advantage, disadvantage. So an advanced subscription agreement, for those that don't know it, is effectively a way to, it's a bit like, it's a kind of convertible loan where people are providing money in advance of a formal fundraising. So for example, you might do, just so I can kind of break down the terminology, because I think it helps understand it. So advanced, as in ahead of the fundraising round, and subscription. So when we talk about subscription, we talk about subscribing for shares in a company. So when you make an equity investment, technically speaking, you're subscribing for shares in a company. So basically, advanced subscription means you're subscribing in advance of a funding round, and generally the benefit of that to an investor is that you might get a discount. So you might say, okay, I'm going to give you £50,000 now, and if you basically that, rather than me paying £50,000 for shares at the full valuation, I might get a 20% discount on that. Honestly, I think, and there are a few permutations. They're not overly complex, but I would say that ideally you don't do an advanced subscription. The ideal situation for a startup raising money is that they set a funding target, they look at what they're looking to raise, and they collate one investor or more investors to invest on agreed terms. So that's the simplest way of doing it. You might use an advanced subscription agreement as where you're not able to do that. So for example, if you're trying to raise a larger amount, but you need a little bit up front, but you don't kind of want to do it as a formal round, you might say, okay, well, we'll do an ASA, advanced subscription agreement now, and then we're on the hook to do a full funding round within the next 6 months. I think the one thing to bear in mind is that the advanced subscription, between the first payment and when the actual round has to happen and when the shares are issued, there can be a maximum of 6 months if you want SEIS or EIS to apply. So if there's longer than that, then then SEIS and EIS won't apply. You can always apply to HMRC to extend that 6 months, but there's no guarantee that they would extend it, and generally I don't think they would. So the advantage of it is that you can get money ahead of a more formal round, and it's kind of more, it's much more straightforward. It's just it's a relatively straightforward document. The money's in your bank account, and then you're kind of putting off the more formal fundraising round for later. The disadvantage is that you're on the hook at that point. So someone's given you, let's say it's £10,000, they might then get a discounted valuation on it in future. So you would only really do that if you need to, is the summary of it. But it's not a bad, if basically the disadvantages also depend on the actual terms of the advanced subscription agreement. So if you basically say that there's no discount, you say that, well, you're giving us the money now and it will convert to equity in 6 months' time at the agreed valuation, then that's fine. But if you're giving a big discount, or if there's any kind of punitive aspect, if you don't raise a full round within the next 6 months, then there can be a disadvantage in terms of the valuation that you give. So the next one is anonymous. So how do bounce back loans come into play in terms of investments, and what effect does it have on your SEIS viability? Good question. I don't know that off the top of my head, to be honest. I think the general position with any loan is that the general position with a loan is that it's not an investment as such. So if someone's giving you a loan of £10,000, you might disclose that to your investors, but it doesn't actually impact the investment itself. That's just something that kind of is one of the liabilities of the company at the point of investment, and the investors will either accept it or they won't. On SEIS, it's a question of whether the bounce back loan specifically is a form of state aid. So state aid generally contributes towards your SEIS allowance. So if you've taken £20,000 as a form of state aid, that would cut into your £150,000 SEIS, so you'd have 130,000 left. What I don't know off the top of my head is whether the bounce back loan is a form of state aid for that purpose. But so the question is a bounce back loan a form of state aid? That's what you need to research on that one. Feel free to come back to me on it. And then, does your company have to be free of debt when seeking investment? So, I think I've answered that. You don't need to be, but you need to disclose it to your investors. And if there is lots of debt in the company, then the investors may be put off. So keep the questions coming in if you have any. So I'm just going to keep going through these through this key terminology. So is there another one? No. So we've got dividends. So dividends is usually a distribution of profits. It's distributed proportionately to the amount of shares that you hold. If you are intending to take part of your salary as dividends, if you're able to, you might want to just confirm that with the investors, just to say that that's a tax efficient way of doing it. Then let's see. That's being slow, so it should come up in a second. So annual accounts. So generally, this is the information, right? So investors will generally say, and the documents that we produce generally say they have information, right? So you can provide them with the annual accounts of the company. They may also request more frequent accounts, like quarterly management accounts, which generally means just what's the position for the quarter that's just gone by. In an ideal world, you want to limit the amount of information that you're required to give to investors. So you might say, okay, well, we have an annual obligation, but if you have ad hoc queries, you can always ask. So that gives them the flexibility, but it doesn't commit you to every 3 months or every month needing to give them a big update, which is going to cut into your personal time. So just always think about it operationally, like what does it mean day to day to have investors? How often are you going to have to email them? How often are you going to have to update them? And you want to be thinking about that and potentially limiting that if you can. So this is a question I get a lot around what is the difference between a shareholder and a director in terms of voting, and what does that actually mean? So the general principle is that directors are they run the company on a day-to-day basis on behalf of the shareholders. So day-to-day matters generally is decided by the directors on a show of hands basis. So even if let's say there's two co-founders, one holds 20%, one holds 80%, and they're both directors. The default position is that they are both, it's 1 and 1 rather than 80 and 20. So you might want to say, and if that is the case, you might want to have a provision which says, that you would want to basically decide how decisions are made and what happens if there's a disagreement between you. So in terms of directors and shareholders, in terms of roles, a shareholder is someone who basically has the benefit of the shares, and the directors are the people who are basically implementing the business of the company on a day-to-day basis. So where do they intersect? It's the fact that the directors are running the company on the shareholders' behalf. So if there is a very important decision, of course it makes sense to have to go to the shareholders to get their approval. So there's certain things where we talked about before, consent matters, where you'll have to potentially go to the shareholders or go to the investors for their consent on certain matters. So that's an important distinction, because some people assume, okay, if I hold more shares, it means that I have I automatically can control all decision making. It's not the case, because decisions are made at board level and they're only referred to shareholders in certain specific situations where it's kind of been pre-agreed to do so. Okay, so we've got another question here. So when a company is set up by one director, shares are set up accordingly. Should the shares be arranged as, say, 100,000 shares in advance of the SIS application, or would HMRC review this during the process? So should the shares be arranged as 100,000 shares in advance of the SIS application? It's not. So basically, it doesn't really matter how many shares you've got beforehand. What I'd recommend is that you should have, generally when I register a company for someone, or what I recommend they do when they register it themselves, and I generally recommend that you register it yourself, is that you do 10,000 shares of £1 each, and then the total value at that point is £100, and then you can issue shares in future as a percentage. You're always issuing new shares to investors. So that's another point. You can only have SEIS and EIS, for example, when you're issuing new shares rather than transferring existing shares. So should the shares be arranged? So yeah, I think that's fine. I'm just trying to understand if I'm missing something on the question. HMRC are not going to look at the exact number of shares that you've got. They're just going to be looking at whether you qualify for SEIS and EIS based on the type of company that you are, and based on what you're doing and what you've done to date. If that didn't answer the question, feel free to type in again, Ryan. Okay, so no problem. Okay, so preemption rights. This is the stuff we talked about before about anti-dilution. So when you see preemption rights, the first thing that you need to think about is it basically just means a right of first refusal. So if you're transferring shares, all the other shareholders have preemption rights on transfer generally, which means that they have a right of first refusal to that transfer. So if you're transferring 10 shares and someone holds 10% of the business, you can't transfer it to the other person until you've offered at least one of those shares to the person holding 10%, because 1 out of 10 is 10%, on the same terms as you're offering to the other party. So that's on transfer. Then you also have preemption rights in the same way on issue of shares. So this is the way, what we talked about before, which means that existing shareholders have a right to participate in future fundraising, because it effectively allows them to, it allows them to participate. It doesn't allow them to stop the fundraising, but it allows them to participate in it to maintain their percentage. But then it's up to them whether they want to invest again at that point. So tag along is kind of more technical, of course. I'll leave them for now. Preference we talked about. Nominal value, that's the value of the shares when you register. So rules and common mistakes. So I'm just going to go through these quickly, and then I'm going to go on Legal Sidekick, and we'll just kind of have a look at some of the questions that we ask on there. So rule number 1: to issue new shares, don't transfer existing ones. Otherwise SCIS won't qualify. And also, if you're saying to someone, I'm giving you 10%, when you're issuing new shares, if you hold 100 and you give them 10, and you issue 10, then there's 110 shares in issue, and actually they hold less than 10%. So you need to actually scale it up. So if you hold 100 shares and you're giving someone 10%, actually it would be technically 11.11%, 11.11 shares. And you can't have fractions of shares, so it would need to be 11 shares, or you'd need to have something like 10,000 shares, and then you could more easily do it. And if you've already registered, for example, like with 1 share, not a problem. You can subdivide your shares very simply using this form SHO2. If you need to do that, let me know. Investors want their money back and more. So the key thing that you need to do is be clear with your investors actually what they're expecting here and what they're getting. If you promise too much and set yourself very, very strict requirements with them, it doesn't set you up well. So it's kind of good to be clear from the outset and not have restrictions from the investors on what you can and can't do, or what you're expected to do. Like if you need to hit a certain target to impress your investors, that could result in you making poor commercial decisions, because you're basically trying to force the money, and it doesn't work that way. And remember, co-founders are party to this agreement too. So you should and there'll generally be some reverse vesting provisions in this agreement, which commit the co-founders to being with the company over a period of time. Could be 2 or 3 years, but it could be longer. Depends on what you agree together and agree with the investors. Okay, so I'm going to take a break from this. I'm going to go to, let me see. I'm just going to go to the platform. So I'm just going to do a quick demo of what it looks like if you were to just create these documents. So let's see, new share. We need to go to, okay. So can everyone see, can you now see the Legal Sidekick page on your screens? I think you can, but I can't be sure. Great, good stuff. Okay, so this is inside the platform. So basically, this is, once you've created a free account, this is where it takes 2 seconds to create a free account. So you can kind of access things in different ways, but let's start by going to the checklist page. So this just gives you an overview. I'm kind of debating on what to call it, whether it's kind of to-do list or your legal master plan or a checklist, whatever you want to call it. This basically gives you a kind of reasonably clear overview of all the various legal things that you may want to implement for your business. So start, build a website app, build team, shares, share options, trademarks. So let's go to the funding one. So we've said here, so apply for SCIS, your term sheet, your investment, your shareholders agreement, your share capital table. So once you've actually issued shares, you'll have like a spreadsheet which will say who holds what, like the number of shares that they hold and the percentages they hold. You issue the share certificates, and then in future you can add new investment. So if we want to go with let's start with the term sheet. So if we want to do the term sheet, you'll click here. There's other ways to access it. You can just go to the contracts tab and choose get funded and choose the term sheet. So I've just filled this one in before. So it saves your company details. So if you did another contract, it will automatically save these details. This will just be dummy information, so don't worry. It's nothing private. So let's say, so that's so basically, let's say we want to change the answers. So just going through these questions is kind of setting up some of the key information that you might want to think about. So have you loaned any money to the company which will be paid back to using the investment money? Generally that shouldn't be the case. That should generally be a no. What's the estimated completion date? So when you send the term sheet, it's quite good to be able to say to them, right, well, we're intending to complete by this date, because otherwise it can drag on. It gives it an element of finality to it. So let's see. So I'll just go through this first. So we're talking about well, let's say starting with the first investor. So what this enables you to do is you do the first investor details, and then you can adjust it later when you download it as a Word document to add additional investors. But you just repeat what's already there for the first one. So you're giving them the agreed percentage, how much are they investing, we have more than one investor, the name of them, and this question is, are they going to have ordinary shares like yours, or are they going to have separate, a different class of shares? Generally, I would recommend saying yes to that question. This is all about the consent rights. So what is the control? This is all about the control we were talking about. So what are the things that the investors may have a right to, basically you need their consent to do? So what we're setting out here is generally like the existential things, or changing the shares which they hold, or changing the agreement which they sign up to, or winding up the company. Then you can make the choice of materially changing what the company does. You can choose the things which kind of give the investors some comfort, but don't really impact the way your company is run. Will they be appointed to the board? I probably, maybe no, but maybe you do want them on the board, and maybe especially if they're not charging for it, that might be a good benefit. Have you got the SEIS, EIS set up? Ideally, you want to be clicking yes, and yes, we have the advanced assurance set up. That's kind of often a precondition for your investors. So this is a question about kind of explaining tag-along rights and drag-along rights. So you basically just have to fill in the percentage which you think is right. Are you a solo founder or co-founder? What percentage of equity will you set aside for share options? So a common thing here, you might see kind of 10, 15%, 5% might be low, 20% might be too high. What's the company valued at? So just kind of put the figure in there. Actually, in your first round, you might want it to be like, if you can say a higher valuation, then great. But it really depends on, how you see it and what the investors are willing to accept. Generally, you have to justify it, but generally these valuations are always kind of, technically they're a bit ridiculous anyway, because you haven't really done anything yet. It's all about it's based on the future. So a lot of companies, you might say a company is worth £1 million before it's done anything, but that to some that may seem crazy, but to others that may seem reasonable, and that's just how it works. So you're listing the details of the individuals, and then so once you're ready to, you'll update your answers. You'll then once they've updated and been recorded, you'll go through so that and then you're in a position to generate your document. So then this takes you to the payment part. So if your term sheet, I believe, is on here for £50, and then the full contract is on for I think £399. So basically it's modeled that you can just create it yourself. I think if anyone's in this workshop and they want to create this when the time comes, you've got the document itself. If you just do this option and you want some support, you have questions, absolutely just ask me. This is more like if you were looking to do the increased price, is more like if you want to make bespoke adjustments to the contract, etc. We charge a bit more for those things. So then you would pay the fee and download the document from there. It's downloaded as a Word document, which you can of course edit. Then if you wanted to, so once you've done that, you've sent your investors your term sheet, the thing that you've downloaded. The 3 simple steps: you choose the contract, you answer the questions, and download it. And then if you want us to review it or support, we can do. So once you've done your term sheet, and hopefully kind of everything we're talking about is a bit clearer now that we've gone through this workshop, you can then go and create the seed investment and shareholder agreement, which will keep some of the information that you've already input, and then you can go from there. So basically what it's saying is, it's not in you having the document, and usually the value that we'd offer on this is once you've created it, we'll help you understand it. If there are questions, we can help you go through it, but generally it's kind of all being well, a kind of a cheaper and more efficient way of doing your funding round, where you still have ability to kind of have personal legal support. So just looking at a couple of questions here. So we've got from Ryan. So if you were to pitch the business to an investor and offer 10% for 300k, you're in essence suggesting the value of the business is 3 mil. As a startup without sales, is this viable? Well, it depends on who the salesperson you are, I think. A lot, and it depends who's investing. So 300k for 10% of, I think it really depends. It depends. I think for a lot of businesses, if you go to an angel investor who's maybe going to make 2 or 3 investments this year, they're probably not going to go for that. To be honest, it kind of depends it depends how rich they are, how much money they've got, and how much of a risk they're willing to take on you. It's not. I personally think that's high, but others may not think so. So I think you'd have to kind of assess the market a bit more on that, and look at, go online, do a bit of research around that. But I would say that that's potentially high. I think generally for your first funding round, it might be that you say, okay, we're raising whatever you raise. You might say, well, we're offering 15-20%, or between 10 and 20%, for example. And if you want to raise 300, you might say, well, we're raising 300k, and we're looking. Your starting point might be, right, well, we want to give away 10%. We want to give away. We want to get 300k. That might be your starting point. Just be aware you might scare some people off with it. That's something that could happen. You have to be prepared for that. Is there a letter of intent on legal Sidekick? No letter of intent. But a letter of intent, I mean, that really depends on what their intent is. It depends on what it relates to. So it would be more something that you're kind of needing to kind of commercially put together and say and summarize it, because letter of intent isn't generally legally binding. So it's more a case of summarizing what you're actually looking for. Okay, so look, that's how the platform works broadly. You can click on Ask a Hugh and you can send a message. And then there's also you can also search for there's a lot of articles on there which you can kind of do to implement to better understand your learning, what you understand. So if I type in, if you're looking to research funding rounds a bit better, I might type in funding round here and search for it. And see, so it's kind of like a mini legal kind of Google type thing. So you're just searching for what you need. So it's giving you these step-by-step guides and various information on that. So how long is it SCIS valid for? So I'm just going to go back to the, I should answer that question shortly. I'm going to go back to the slides. So those are my email addresses. Either of them will reach me. So if you have questions, you can ask. I think if you're a member of Legal Sidekick, I'm much more likely, if you're a member, it's part of our customer service to be able to provide you with responses to your questions. If not, I need to consider the, what the fees for services are effectively. So let's see, how long is a SCIS valid for? So it's basically the advanced assurance is well, you can only raise SCIS in the first 2 years of trading. So an EIS doesn't have that time limit on it. So you can continue to raise with them, but SCIS is within the first 2 years. Once you've got your advanced assurance, that generally is going to kind of remain valid so long as you're eligible for the schemes, because it's just a question of your eligibility. So that advanced assurance is valid so long as your what you've said in your application doesn't change. So it's a question of, I think overall, this is a question of, yes, you have a kind of, all being well working with us, you have a simple way of implementing this, but importantly for your own kind of entrepreneurial development and understanding, it's important to know what's in here and to be able to critically analyze things and make adjustments if you feel you need to, of course, like with our support as part of the process. If I just look at the practicalities, so yeah, if you've not done so already, I'd recommend doing your EIS, SCIS Advanced Assurance. We can help you with that if relevant. And 1 second, I was looking at the chat. So term sheets doesn't need to be signed, but it's good to get it out. Follow with the full agreement. And once you send the full agreement, it's a case of saying, please sign it and send us the money. And then there's some administration to do after the actual share issues and the share certificates. So I'm just going to look at the chat question from Pankaj shortly. But I think generally, if you are raising investment, obviously be in touch with me. We can kind of take you through the process and help you implement it, either using Legal Sidekick or using kind of more bespoke legal services, which ultimately depends on the approach you prefer to take. But I think most people in here would prefer to take the kind of more cost-efficient approach, which is using Legal Sidekick. So question from Pankaj: I have an investor. What tax year does the SCIS? What tax year does the SCIS? In what tax year can he claim the SCIS for? I think so. Once he's made the, it can be basically backdated, so you can make the investment and then you can apply for SCIS. I don't know exactly what tax year it would apply for off the top of my head, but yeah, feel free to be in touch with a kind of specific question on that. So I've got a question from Philip. So how often do investors come with their own term sheets? So good question. So if you're going to an angel investor, it's going to be your term sheet more often than not. If you're going to a VC fund or a more institutional investor, that's when they'll send you their term sheet. And then frankly, that's a much more, from a legal perspective, that's going to be a more expensive exercise because you're going to be negotiating someone else's documents. So rather than just having everything lined up yourself, you then you're going back and forth with them. But generally, if it's an institutional investor, they're actually going to be investing a lot more. So you're probably more happy to invest in the more in the legal costs. Let's see. So one more question. So the advanced assurance allows the investor to claw back 50%. Is it worth leveraging an offer of less equity on the basis that they're realistically getting it back anyway? Absolutely, yes. You can factor that into your valuation. You don't need, I wouldn't say that explicitly. I wouldn't say to them, well, you're getting 50% back anyway, so we're going to make it more expensive. I think you can you have to be a bit more subtle with it. But yes, I think it's definitely a selling point of a higher valuation. So, yeah, I think generally this hopefully puts you in a clearer position. So when the time comes, whether that's soon or not so soon, you'll be in a decent position to pursue this and create your, close your funding round in a clear and straightforward way, and in a way that you're clear with the process. The practical aspects after your investment is actually closed, I would say worry about it less. The first thing ultimately here, the difficult thing is getting the investment and having it lined up to valuation you've agreed. But once that's ready, this hopefully puts you in a good position to close it all out and get it closed out in a smooth and efficient way. Does anyone else have any questions? Have any questions on this, or anything to do with implementing it, or the services that, or anything that's ongoing at the moment? So if not, then we'll wrap up. Obviously, you've got my email, so if you want to contact me or ask further questions or anything that you felt was private and you didn't want to share it in a workshop setting, then let me know. And otherwise, I'll see you next time for the next workshop. I think that's all. You're welcome, Zafar. So yeah, feel free to start leaving now. But thanks for attending, and look forward to next time.